Now let's take a look at the bigger picture. Dana Giorio is with us, co-CIO at InvestNet, joining us live from the Schwab Impact Conference in California. I'm glad you're here, Dana. Nice to see you. How's the conference going? A lot of hustle and bustle, and what are they talking about?
You've got it. It is a ton of hustle and bustle. It's actually been a tremendous experience thus far. You can see behind me thousands of people here, RIAs, learning about the latest and greatest state of the art in the advisory business and technology and the ecosystems available to them. So it's really been, as Schwab Impact always is, it's an event and a very good learning experience for the RIA community.
That's great. Nice to see everybody there together, growing, learning, seeing old friends, making new ones. That being said, some Fed speak, I'm sure. We've gotten some hawkish words lately, but we have the Fed December meeting, then January. There are some folks who are in the 25 in December, pause in January, and even say that's the end of the rate cutting cycle. Where do you stand?
So I've always been, and in all candor, maybe a little bit too much. I didn't expect the 50 basis point cut that we got earlier, but I've been in the camp that the Fed is really best served to be careful about lowering rates. Inflation does tend to come in waves. We haven't really broken the back of inflation. We had some good reports, but we really never got to a point where we said, this is a done deal. And now we're seeing inflation is a little bit stickier, right? And we, of course, now have potentially fiscal reasons, the extension of tax cuts, to think that maybe inflation is still going to be an issue, tariffs, right? So if you're the Fed, and again, your mandate is inflation and employment, and the employment picture is still holding fairly strong, but inflation looks like it may be able to rear its head again. I think you're going to be cautious on rate cuts. If there's a fail for this Fed, it is to let inflation come back again, particularly after what we've already endured over the last couple of years.
Do you think, for example, I was just talking about the S&P target of 6,600 by Wells Fargo for next year. They thought the Trump administration's bullish ideas or administration that's more business friendly would actually help the market and move it to new highs. Do you agree with that?
Yeah, I think expect Trump to run it hot, right? To the extent, and we all know the literature on this. It's hard to always directly connect presidential or congressional policies to what happens in the economy and the market. But to the extent that there's an expectation there from the market that pro-business policies, taxes for corporations being in a better state. I think there's reason, to expect, and obviously yields as well are demonstrating an expectation. Real yields are demonstrating an expectation of growth. So yes, I am. I don't think you can necessarily count on the tailwind, though, of lower interest rates to be part of that story.
Yeah. How would you go about investing in certain sectors? I saw you have certain sectors you think could move with the Trump administration's ideas and policies. Are there some that you think you're definitely investing in for, from now on?
So, of course, we've had the Trump trade that's been on for a while. I think for sure, if you called the Trump presidency, you probably made a buck if you were invested in the Trump trade, right? Lower regulations, so pharma, financials, areas that are benefited by this, fossil fuel companies. Certainly, you're benefiting. I think the question, of course, now is, can you still invest there and expect to benefit? We already know Trump is the president. We already know it's going to be him in charge and policies that he wants to enact and Congress as well. The market has priced that in to the extent it's able to price it in. So now, of course, if you're investing in those sectors, you're not just making a bet on who's going to be in charge, but you're also making a bet on how well the market has priced in, already knowing who that is, which is, of course, a much harder place to be. So I'd be careful about taking sector bets at this stage of the game based on that. I do think if you think about areas like small caps, if we do have tariffs, maybe they're less import sensitive. But on the other hand, if we have higher for longer on interest rates, that's a negative for small caps. So, all in, I'm in the camp of obviously diversified portfolio, maybe tilting a little bit into the small cap, particularly small cap value space, as I always think that's a good long run bet. But taking, bets on fossil fuels, fossil fuel companies did better under Biden, right? And renewables under Trump. You just can't always translate that well, the expectation to what the market is priced in.
Yeah, understood. And small cap value, as you noted, another area. Folks who love small caps really were sort of left behind over the last decade. But as you noted, a diversified portfolio. But you're more bullish overall, right?
I am, and if we're in an economy of risk on and all boats rise higher, that is going to benefit small caps.
Okay. All right, good to see you. Dana Doria, co-CIO at InvestNet. They're live at the Schwab Impact Conference. Thank you for being with us. Enjoy.